And now I have added Mark, our co-host. Mark, I'm so sorry. We're gonna have to start that all over again. I got a couple of messages in the chat and from colleagues that they were in the waiting room.
No
So
worries.
hopefully you can understand that sometimes things get a little bit confusing. So let me restart. Thank you all for joining. This is my second intro of us diving into some of the most compelling findings from the latest global research we've done on agency valuations, both productive and Cactus. I'm Maria, for those of you who haven't seen me before here, and joining me here today is Mark Sainthill from Cactus. Mark, thanks for being with us, and thanks for your time today.
Good to be here.
Thank you. A little bit about productive. You could see my screen, right? Okay. So, for those of you who don't know, Productive is a platform designed to make agencies more profitable. How? It basically lets you consolidate all of your agency processes. So from biz dev, project management, resource planning, time tracking, reporting, and all the way to billing. So agencies around the world use Productive and rely on Productive to keep more organized and to keep more profitable and to run their day-to-day operations. A couple of years ago, we noticed that M&A action is really heightened in the agency space. A lot of agencies are looking to merge, to buy, and we launched this agency valuation calculator for the agencies in our space and beyond to be able to kind of assess just on a preliminary level what their market worth is, right? So we got about 800 responses last year. And that's what we're going to go through today. But we also noticed that Cactus is quite an interesting survey on agency valuations as well, or M&A activity. So joining me today here is Mark Sainthill from Cactus, who is here to who actually takes care of the M&A side regarding agencies. So if you could just tell us a little bit about yourself and Cactus again.
No worries. Thanks, Maria. Yeah, Cactus has been around for about 15 years. We've helped agencies of all sizes, really, but predominantly the founder looking at their kind of growth plan and business plan and supporting really areas where they have gaps, or provide fractional support. So things like the sales and marketing of their business, finance support in terms of like CFO support. We do lots around kind of business planning. What's the future of your agency look like? And we talk about the now, next, and future, and the organizational design, which is obviously changing around technology. So it's less about just pure headcount and it's more around your tech stack, leading into the kind of AI transformation stage. To what extent and how do you embed AI tools? Which ones do you use? How do you create a strategy and a culture around the automation and improvement of your business through AI tools? So my side of the business is more M&A. So we help founders look at look at their exit options, look at the options between acquiring an agency, merging, or selling to a group, and give them a sense of the value of their business and the key levers that are going to drive attractiveness and interest from buyers.
Very good. I can imagine the AI side is super hot right now. Besides the weather.
Yeah, it's about hot, as hot as the weather. Yeah.
Yeah. So today, what we'll cover, basically a little bit of research background. So both surveys, what we asked, what we found, and then we'll dive into trends on revenue, client concentration, business development, management maturity, how robust the management of agencies are, how they think of themselves, also in terms of transitioning later on. Also tooling and data consolidation, which is something important for buyers. and we'll wrap up with the traits of high valuation agencies and give you some key takeaways, hopefully. Cactus did an interesting survey. I mean, quite impressive. 2,500 agency industry leaders on M&A intentions. Can you tell us a little bit about this, Mark?
Yeah, this is the first time we've done a survey of this kind, and yeah, we wanted to get more insight beyond, just the pure valuation and look at the sort of, as I said, intentions of agency owners around appetite to sell. What are their kind of what excites them, what motivates them, what concerns them about that potential kind of selling something that they've set up and built over a number of years, and also talked about their appetite for merging or acquiring businesses. So I think people definitely are looking a lot more at this, given how much the landscape's changing and the disruption, that actually, merging or acquiring is a good path to growth and securing greater value in their businesses. So yeah, it was an interesting piece that we should do every year, and will probably probably still be the same next year in terms of appetite, given all the uncertainty.
Sure. Yeah, sure. So what I thought was interesting and that we could definitely add in to make this webinar more complete are what you guys found for factors of considering to sell. So as we could see here, like a lot of them are trying to realize the value of what they built, ensure long-term sustainability for the business.
Yeah, so these are the sort of top kind of four themes really. So I think, obviously for most founders, this is they put their time and all their money and energy into building their business. And at some point there's a point that they probably look at and say, I'd like to realize some money for the efforts I put to date, with with the opportunity to kind of continue building in a different form. It's not purely financial, to remain competitive and relevant. That the opportunity to join with other businesses with other capabilities is obviously attractive, and look after the team, and give them greater roles in bigger organizations. So there's a sort of protecting risk, creating new opportunities for the business, that in equal measures, in terms of securing the short term and long term future of the business.
And then similarly, but a little bit different for considering to acquire, right? Increasing their revenue value, acquiring talent as well, with that.
Yes, I think I mean, scale is important for a valuation multiple, for sure. So I think, we talk in the market around hitting certain milestones of EBITDA or profits of 1 million, 2 million, and up to 5. It's very difficult organically to do that as the business grows and reshapes around larger clients, and the market's just been challenging. So in order to speed up to hit those kind of bigger ambitious targets, many people look to acquisitions to help create that scale. There's synergies around looking at synergies around clients and around costs, is what all the big holding companies have done, and it's definitely a real trend in the last year and this year, that consolidation of this big landscape of agencies is there's almost too many of them now, and it's about looking at who can join forces and build something new and different. And talent's a big part of that, of course. So certainly some traditional agencies might look for kind of younger talent or people with kind of more technical skills, and there's always a natural leaning towards geographical expansion, so that bigger groups can have talent in the different parts of the world. But the overarching thing is, this year is market consolidation,
Hmm.
people joining forces to kind of be more efficient, build bigger, better propositions together.
Understood. From our side, what we kind of built this custom-made methodology that was reviewed by experts, which includes both quantitative and qualitative data. So as I said, we spoke to, well, we got data from almost 800 agencies, 783 throughout a year. And just to give a little bit more background, so the agency size is like almost two quarters were up to 10 full-time employees, while another quarter was in the 11 to 20 employee range. After which come the little bigger agencies. And regarding agency type, we had a lot of media and performance marketing, software and digital product agencies, as well as design studios, video production studios. In terms of revenue and client concentration, um, there was like most agencies had up revenue up to 5 million USD, while another 20% were between the 5 to over 10 million, right? What we saw was interesting was that um, revenue from a single client for 15% of that whole pie um, so they derived around 25% of their revenue from a single client. Is this something that you see often? Does it hurt a valuation to be so reliant clearly on one client?
Yes, in short, I think, I mean, the challenge is for agencies as they start out, they'll have smaller clients, and as they get bigger up above to 5 to 10, they can't service a long list of small clients. They start to get, service bigger and bigger and win bigger and bigger clients. And with those, obviously, they can become quite large parts of your revenue mix. But in terms of a sort of valuation and buyer perspective, if one client is more than 20%, some buyers would say less than that. If it's more than 15%, there is a risk that obviously if that client goes and walks, there's a huge amount of value lost in how that business is looked at. So if you can keep it below, to any client below 10%,
Yeah.
that is the ideal target to go for. But naturally, if you've got a large client that is very successful with you, that you don't want to resign it for the fact that they're gonna uh,
Yeah,
take up more revenue than a sort of industry benchmark. But it is perceived as risky for
it is something
buyers.
to work on.
Yeah.
Yeah, yeah. Yeah, then we actually looked into the recurring sources, the revenue generated from recurring sources. So here we see that nearly one third of agency got 80 to 100% of their revenue from recurring sources, which was pretty incredible. On the other hand, we had 42% less reported less than 50% of their revenue as recurring. Should agencies always aim for more recurring revenue, or is there also like a threat there?
I think naturally clients are signing up to less and less retainers or recurring revenue and long-term contracts. I mean, obviously, if you can secure multi-year contracts and monthly recurring revenue, it helps with resource planning and certainty around the future of the business.
Sure.
I'd expect that 30% of which have got 80 to 100% retainers are probably in the kind of performance media space, and there's probably very few in that bucket that belong in digital products because it's all moved to projects. So I think the nature of certain parts of the industry just mean that it's harder to get retainers. But if you can get multi-year programs of work, master service agreements, and be on the kind of big rosters for clients, all of those things are kind of positive signals to buyers that you've got a deep relationship with that client, even though it might not be recurring.
Yeah, yeah, it does say something also about your brand on the market, how it's perceived, how it's recognized, right? Um, we also looked into business development maturity. It's something that agencies struggle with naturally because the smaller the agency, the more founders and CEOs are involved in biz dev. Here we saw that only around one-fifth of the agencies that responded have biz dev teams that fully own sales. And the same amount, more or less, claim to have active outbound and inbound strategies. So Mark, is this a situation that's been improving with time? Are agencies getting more serious about, um, excluding founders or CEOs and kind of focusing on getting at least a one person or a team around sales and marketing?
Yeah, it's a good question. I think with, pipelines being more uncertain, client revenue being kind of delayed or cancelled at last minute, I think there is a lot more of a drive for new business within agencies. And that's really for, the best agencies, everyone in the agency steps up. Typically, if you've got a strong founder who's strong in sales, they tend to lead those big pitches, and they're actually the best people to articulate and convert those. But there's definitely, a lot more people looking at a sort of more formal marketing plan with, we at Cactus, we've got a 42-point plan around all the different types of activity that would lead to, a sale or winning a new piece of business. And that generally requires, a marketing manager, people within the business that kind of focus on more than just waiting for inbound leads or relying on existing clients and client referrals. So I think more and more now, as client businesses change and the world changes, you can't rely on your current relationships to continue with growth. So whether you need to bring in a sales director or business development at the director at a senior level is dependent on the rest of the team, but certainly more investment in that area is definitely necessary.
Mm-hmm, mm-hmm. When it comes to management robustness and the transition period. So we saw that almost half of the agencies that filled out our survey had some form of management in place, but they're still highly founder dependent. And another 22% said they have basically no management layer at all beyond the founders. How does that affect valuations, and what are buyers really looking for in terms of like management strength, transitioning, and the whole process of, after an M&A?
Yeah, I'd say it very much depends on the size of the business. I mean, when the business is, 1 to 3 million revenue or 1 to 2, you don't, there's no need for a sort of formal sort of layer of management. It
Sure.
depends how many founders are in the business too. There can often could be one or there can be three. So you really have to look at the kind of skill sets you need across that leadership team and find out where the gaps are and either hire someone fractionally to support it until you can hire someone full time. But ultimately, when it comes to the process of selling your business or being attractive to buyers, they will look at the capabilities of firstly the founders because they'll want them to stay on if they've created a business that's succeeding and growing. But they'll also see risk if there's one founder rather than several key people in management in case that person leaves. So you need a sort of a balance of it. But some buyers will be looking for certain skills than others. But I think yeah, having a single founder is definitely a kind of risk for buyers. But there's no need to have, layers and layers of management as much
Yeah.
anymore as there used to be.
Yeah.
You just need, technical people to help kind of structure around your tech stack and whatever kind of are the key roles that fundamentally build value in that business.
Yeah, and speaking to that, so we asked how long they would, well, leaders or founders would stay post acquisition. A lot of them said, well, 50% said they would stay for 12 to 24 months. Is this something that you typically see? And how does this relate to how does this shape negotiations, or how does it shape valuations at the end of the day?
Yeah, I mean, for much bigger businesses where the founders kind of transitioned away and built a management team, it's often not necessary for them to stay on. But if you're in the sort of 5 to 10 million revenue area, you are going to be critical to the business, and the buyer is also kind of buying you. They like you, you like them, and therefore they want you to stay around. They don't want you to disappear. So more often than not, the majority of the time, deal structures and valuations are based around founders staying around, and that's often for 2 to 3 years' time. And increasingly, we're seeing deals which also include a share element, which is, minimum 3 years. So they want these founders to stay on with the journey for them to then reach a point where they sell rather than sort of disappear after a year. So I think if you're looking to walk away on day one when you sign, that's going to be difficult for buyers because they've got to bring someone in to replace you, and they're worried about clients and staff leaving, and the deal structure will and the valuation will reflect that. So ideally, you plan ahead your exit and have a 3 year window where it's going to take a year to sell. And at least two that you have to remain in the business, focused on growing and getting the valuation as per the deal structure.
And it's a whole different topic, and we're not going to talk about that much today. But I imagine that you also in getting these deals together and seeing them through, you also have to make sure that it's a good cultural fit, right? That there's chemistry between these two teams, that they're going to work well together. Because even if even if they're wanting to leave ASAP after the deal, that is something that's viewed as negative. But then what if they're not a good cultural fit and they have to work together for 2 or 3 years? That's also could be a whole different topic.
Yeah. I think however exciting the deal structure is and the opportunity to earn, a lot over that period, if you're not going to work well together and you don't gel from the offset in the build up to agreeing a deal, it's unlikely that that sort of magic's going to happen. And I think it's better to go with someone, and be part of a group that you're very closely aligned with, think and operate in the same way and have the same kind of vision and plan. It's that part of mergers and acquisitions is where value's lost significantly when you just do it on a spreadsheet. So
Sure.
yeah, very important.
Yeah. Now, finally, a little bit about tooling and data consolidation. So we found, I mean, partially also this is because a lot of our own audience was taking the survey, that 47% of agencies now use an agency management platform to run their operations, but a lot of them still use a mix of different tools across different departments. There's always spreadsheets. How important, in your opinion, is data consolidation during this due diligence period, and trying to showcase how well your agency operates, where all your data is, how are buyers expecting to see visibility into financial and operational metrics nowadays?
Yes, I mean, I think, yeah, I mean, buyers want as much data as is available, and if there's gaps in that data, or the data is very slow to produce, or inconsistent, it does become a bit of a flag in the process that people aren't tracking the right metrics and don't have the right information at hand. There's more governance things around, contracts and
Yeah,
in doing your filings for your company and tax and things like
sure.
that. And then there's the more commercial information and
Sure.
how you track your utilization of your staff, your client profitability, the metrics, how your split of services, and all the kind of finer detail around what's driving growth and revenue. That's all pretty fundamental, first of all, to the story of your business and your business planning, but also like how uh, what you're selling and what's going to be exciting to a buyer.
Mm-hmm.
And in time, obviously, if everyone's talking about efficiency now, and these spreadsheets can take ages and there can be errors. And I think
Sure.
there's finance people spend a lot of time checking them, and you don't spend enough time looking at making decisions, business decisions based on the latest information. It tends to be very kind of old or inaccurate or incomplete.
Sure. Yeah. Um, Last but not least, we'll go through some of the traits of high valuation agencies. So from our end, we saw that a lot of the agencies that went through our questionnaire had strong management teams, A lot of them had like no more than 10% of their revenue from their largest client. As you mentioned, that's like a goal. 33% had inbound and outbound business development strategies in place, longer founder commitment post-sale, and heavy use of business platforms to integrate their data. On the other hand, something that you mentioned when we spoke earlier uh, was like these future-facing in-demand services, right?
Hmm.
And
I think the market's shifting quite quickly where clients and agency groups aren't, to use, I have to bring it up again, the AI solutions, which is a big growth area. And where it was digital product and it was building websites and apps has now shifted to, actually creating solutions with AI. And there's, it's a bit of a race. Where are they tech platforms that do that? Are there kind of services businesses that can operate and facilitate that? So I think, it's that shifting valuations and also creating much higher valuations for these new businesses. I mean, there was a deal announced a week ago for a 10-person company that went for 80 million, which does vibe coding. So that's a good example of someone where there's scarcity in the market, high demand from clients and from traditional buyers. So
mm,
it's difficult often to shift your business quickly, but there's definitely value in sort of looking at where that demand is coming from and trying to build your organization towards something that obviously clients want and you can charge higher prices for.
mhm, mm,
And yeah, with clients, high quality clients where a buyer can see themselves cross-selling into is obviously part of the kind of synergy work. And any business that can demonstrate consistent profitability year on year over a period of time and growth is going to be one of a few, given the kind of roller coaster we've been through. So um,
sure. Yeah, yeah, that all makes sense. Um, so some key takeaways just to wrap up before the Q&A. Obviously, try to maintain healthy margins. We have a good question here in the Q&A. I'll open that later regarding profitability and margins. Another thing is like invest in leadership development, reduce founder dependency. At the same time, what you just said, so target new verticals. Also develop, work on your business pipeline and try to make sure to centralize finance and ops and project management, resourcing. It'll all be an asset when speaking to potential buyers um, or just going into a new deal, right? Couple more things that maybe you want to point out, Mark. So something that we found, in your survey that is like, and obviously you guys have seen a lot of action going on. So the M&A market is bursting with opportunities, right? But it does come with its challenges.
Yeah, I think everyone will see the kind of press and the news. There's lots of acquisitions and consolidation going on, merging of businesses, and some of it is kind of about costs. Some of it is about kind of creating something new. So I'd say the challenge is the timing of the market in terms of when buyers are interested in what you're offering versus when you as a business are ready, and what is your kind of business plan, and when is the right time to go out and look for a business to merge or sell to. So I think it's there's always this sort of balance of timing when bigger companies are looking internally about their structures and AI. Are they looking to do acquisitions or not? So there's a very broad like group. There's multiple groups of different types of buyers wanting different things at different times. So it's kind of understanding that and how you fit with them. And as we talked before, it isn't just about a deal structure on a spreadsheet. It is very much around how your people and your team and your culture, if there's a fit there, then there'll be success, and people will want to stay for the journey and beyond. Without
Mm,
it, often these kind of deals kind of end up not creating value, and people kind of leave early, which is obviously not good for anyone.
yeah, yeah.
Um, But yeah, getting your kind of information together and having a plan and an exciting kind of vision to talk to people about, is critical. And get advice, and that's across M&A, legal, tax, and make sure your business is ready and there's going to be no kind of issues along the way. And yeah, stress tests what your valuation is with someone who understands valuation and deal structures, so you don't go into a process either with higher valuation expectations or not knowing, who your likely kind of buyer groups will be.
Yeah. No, even just for like, even if your agency isn't even looking into being sold or buying at the moment, it's something to think about. And as we saw, many have the intention to do so. So it's always a good idea to understand where you stand now, what you can work on in the near future, and how to, strategically shape your agency into something more valuable for the market. So yeah,
Great.
obviously Mark is here for that, not productive.
Yeah.
Now on to the Q&A. Yeah, this first question here, how important is recent profitability? So if an agency has been profitable in the past, but made losses in the most recent, so 1 to 2 years, does this torpedo a likely valuation, or will acquirers be willing to understand short-term market challenges as long as there's been a turnaround or there is a turnaround plan?
Yeah, I think if there's fluctuating performance and you have a year that's a loss and then a year that's, profitable, they'll want to understand the drivers of that. But yeah, very much focused on where the business is today, the likelihood of, profitability going forwards. They'll spend more time on due diligence, and the deal structure will tend to be, more deferred because if you've got 5 years of consistent profit growth and retained income coming through from next year, they can pay more of that value up front. So they'll probably shape the deal differently. Now, if the overall valuation, it's really looking at the overall deal structure and what you're going to get overall as a starting point, and then obviously how much you get up front is fairly critical. But it's really digging into that offer and understanding the risks and the upside in it. But yeah.
Okay, thanks. We had another question here in the chat. What was the multiple on EBIT or revenue from that 10 people company? The one that you maybe.
I'll have to get back to you on that. I'm not sure, but yeah,
Yeah,
pretty.
we have a couple of questions from Christian. So what was the percentage of agencies having a software selling tool to and in which direction are the multiples heading further south? We can always get back to you. We have your email address, so
I'll
Mark can.
tackle a couple of them.
Yeah, yeah,
The
yeah.
first one, I'm not sure what the kind of the revenue or kind of how the multiple worked on that deal, but they were only started 8 months ago, so yeah, I mean they haven't even done a full year of trading, so it's quite a phenomenal kind of outlier in terms of an example of a deal. I think in terms of people who are building software within their businesses, I think that's very smart. It's a question of whether build using existing AI like tools, or whether you create your own kind of bespoke AI tool. I think there's a danger that technology is moving so quickly that if you build something, it'll be outdated. But I think if you can build something where it can ingest and you can capture all your knowledge, and automate how you deliver your services, I think that's going to be very exciting for buyers. Obviously it's going to be more efficient, but I think your data and your approach is key, and just finding the right tools to work. I think building your own tool and be able to sell it separately is not going to work. They're just going to have to be part of your sort of secret sauce of how you deliver, and hopefully it drives stickiness of revenue and profitability alongside it.
Yeah.
Third question.
There's another, yeah, I hope that answered. There's another question in the Q&A. Typically, how long do transactions take to complete operationally from initial discussions with the buyer through to day one of the new organization structure?
Yeah, I mean, from finding an interested party who's going to who puts an indicative offer on, I'd say it takes a couple of months to firm up a detailed offer, and typically 3 months to do due diligence. But if you're going out to market from the start, you might need 6 months in market to make sure you reach all the potential buyers. Some will be in the middle of a deal, therefore, you need to wait if you choose to. But it's better to do obviously preparation's important, but time in market is also critical because there's lots of different things going on in terms of dynamics in the market, and you can't shut a window to close a window to 1 or 2 months and expect offers to come in without missing out on opportunities. So overall, a deal will take, anywhere from 9 to 12 months, that end to end. But the actual process from offer to completion should be 4 months, I'd say, because due diligence tends to take 3 months as standard, but it can be done in a month, but it's quite stressful.
Hmm. Yeah, with all the other things going on at the same time. Another question from Christian here. What is an average fee structure for an M&A firm?
So the average sort of, I don't know whether that means sort of average deal structure for
Fee structure, yeah.
fee structure, how M&A firms charge. Okay. It does vary. I mean, it's typically either a retainer through some preparation to completion with a success fee. Sometimes it's kind of a project fee and milestones and then a success fee, but typically M&A fees are aligned to the founder and a successful outcome. So that's generally how it's structured. Um, so yeah, and any other detail you can send me an email.
Yeah, we'll share. Just before wrapping up, one more here. We're still early to talk about sales, but we'd love to transform the business and be more future ready. Could you please share some successful samples about PR digital content agencies, what and how they have done the transformation? We understand using more AI tools and enhance internal efficiency and management systems. Okay, we could try to find some.
That sounds like a project we could do for you, whoever that. Yeah, no, I think transformation is I guess you've got to figure out where the market's going, where you are today, and try and look at the tool sets and what you do internally and who you partner with in terms of tech partners. So I'd say there's some amazing technology tools that clients can't use, and if you partner with them and are able to get the most out of those, that's obviously a great way to go. But there's lots of different ways. It sort of depends on your clients, your capabilities, and where you want to go with your business. But yeah, difficult. Good question. Difficult to answer just generally. But get in touch. I'll try and give you a better answer.
Last one. Mark, what are your top tips for undertaking due diligence on the buy side?
That's a good question. I mean, depending on your capacity internally and whether you've got internal finance people or tax people or legal people, I think just find some external support to do it because it's very time consuming. You can choose a smaller firm. It doesn't have to be a big law firm or a big tax firm. So yeah, pick your advisors. And get different viewpoints on it, but look at it in relation to the deal size, and ensure that you're not you want to do enough due diligence, but you don't want to sort of kill the process, extend it out, or cost a lot of money. Lots of things, protections can be put into the kind of legal documents that can sort of stop you going too deep into DD and doing sort of forensic auditing. So yeah, being practical around what is important and what you're buying and where the value is. Could be client contracts or it could be staff, and focusing on those areas specifically. But yeah, good lawyers are expensive, but worth their weight in gold.
Yeah, don't we all know? So, if that's about all, like, well, any questions that you have, you can get in contact with us and Mark, and we will make sure to get back to you. It's been really insightful. Thank you, Mark, for your time. I hope this was valuable for you guys as well. And as we said in the chat earlier, we'll get the recording and webinar slides out to you in the next day or so. I'll also send you Mark's details so you can contact him with any other questions or maybe even an M&A you want to see yourself.
Thank you very much, and thanks everyone for coming.
Thank you.
Take care.
Bye-bye.
Bye.